organized jointly by Banka Slovenije and European Investment Bank. This event builds on the discussion from our 2023 conference, once again placing green finance and investment at the center of our debate. This underscores the recognition that risks related to climate and environmental change are among the most pressing global challenges of our time. Confronting these challenges calls for collaborative action and shared responsibility toward significant investments across the EU, alongside our other measures. According to Draghi's report and some other studies, the EU must allocate additional green investments amounting to around 2% of GDP annually by 2030. Despite the funds available at EU level and the reformed EU fiscal governance framework, we can expect a public funding gap for green investments in the years to come. As public finances are increasingly strained due to security concerns and aging population, Europe needs strong framework also to attract and efficiently deploy private capital. The recently launched Savings and Investment Union strategy that builds on one hand on Capital Markets Union and on the other Bank and Union projects is an important element to support massive green investment needs. A more integrated and deeper EU financial system, complemented by advances in financial literacy and ideally positive shift in our mindset, this would enable a more efficient allocation of savings from businesses and citizens. While Europe remains committed to ambitious climate goals, the strategies and processes guiding the green transition continue to evolve. A perspective that gained traction over the last year is how can Europe reconcile complexities of global competition and environmental imperatives and balance ambitious climate goals with economic vitality. In February this year, the European Commission unveiled its proposal for Clean Industrial Deal, outlining strategies to unlock investments in clean energy, decarbonize and revitalize Europe's industry. Another important initiative is the Omnibus Simplification Package introduced by the Commission in February. By simplifying the business environment and reducing administrative burdens, Europe would enhance its global competitiveness and ultimately spur investments, including those supporting green investments and green transition. However, this drive to simplification is not without its critics and concerns that easing regulations would undermine corporate accountability and stall process toward our climate objectives. When introducing adjustments, policymakers must ensure that the underlying strategies are both ambitious and pragmatic. At Banka Slovenije and within the Eurosystem, we are committed to play our part by increasingly incorporating climate-related issues into our analysis, decarbonizing our monetary policy-related corporate bond holdings, and implementing climate-related measures in our collateral framework, greening our non-monetary portfolio, and as supervisors, encouraging and directing banks to identify, measure, and manage climate-related risks in a timely and comprehensive manner, ensuring they remain well-positioned to support economy and green transition. Before we move to our discussion, let me first give the floor to Head of European Investment Bank Group Office in Slovenia, Mr. Simon Savšek. Thank you.
Dear Acting Governor, Excellencies, dear friends, it's a great pleasure to join Acting Governor Dolenc today in speaking to you about some of the most pressing economic challenges for Europe and Slovenia, and we are doing this at the Bank of Slovenia, where I also started my professional career, so I'm super happy to be back here. Let me also use this opportunity to thank the staff of Banka Slovenije for co-organizing this event with us. What does the theme of this year's conference, Revitalizing Investment for a Sustainable Future, mean? A sustainable future is achieved once environmental, social, and economic systems are balanced in a way that they meet the needs of the current generation without compromising the needs of future generations. Sustainable investment is a crucial driver of productivity growth. By investing in capital goods, R&D, human capital, sustainable infrastructure, and other intangible assets, one can achieve higher levels of economic growth. This is becoming, of course, increasingly difficult to guarantee as the world becomes more fragmented and the need for security intensifies. Europe's productivity growth has consistently lagged behind major economies like the US already before this fragmentation. We have seen the recently launched EIB investment report that provides extensive evidence on these structural gaps and sets the stage for European policy responses. Our chief economist, Debora Revoltella, will go into greater detail on this. But let us be clear, there is no sustainable investment without security. Sustainable investment, like most of the investment, is predominantly about managing risks and setting the right expectations about the future. And this is why this conference today becomes very handy at the moment. How can we guarantee sustainable investment in this new geopolitical context? Let me turn to a few challenges for Slovenia. Slovenia is a very highly open economy with a diverse export base, which makes it particularly vulnerable to economic shocks and geopolitical uncertainties. Within this challenging context, investing in innovation and digitalization has been a key source of firms' competitiveness. In line with EU firms, and unfortunately, Slovene firms continue to focus their investment more on replacement than on on capacity expansion or on new products. But there are also some positive signs. Our IB's findings for Slovene find that Slovene firms manage to utilize and adopt more digital technologies than the EU peers. Also, almost 1 in 2 Slovenian firms report innovation activity in 2024, which is in line with previous findings and still above the EU averages. I'm not going today into greater details about the Slovenia R&D intensity, but if one reads the reports of the banks of Slovenia or IMAT, you will see that the business investment is the one that is a problem. So the question really is, what is holding back productive investment? And I think there are 2 factors that we can point out at this stage. One is a shortage of skilled workers, and the second one is limited access to external finance. Let me go a bit deeper into that. When identifying investment barriers, the availability of skilled staff remains the key concern, both for the EU and also for Slovenia. In Slovenia, we have a very high educated workforce with the highest percentage of PhDs in Europe entering the high-skilled labor market. But at the same time, our evidence shows that Slovene firms invest less in their employees than the EU average. With aging being one of the key concerns for the country, Slovenia is short of professionals in construction, healthcare, ICT, and engineering, and such trend can be very worrying going forward. The second hindrance is access to finance. We have now the new study also from the Bank of Slovenia that Vice Governor is going to present, and we are very similar with these findings also at the EIB. We can see that Slovenian EU firms do remain conservative when it comes to accessing external finance. Indeed, according to our survey, about 70% of investment in Slovenia is financed exclusively with internal sources. And one problem that we currently have is also the Slovene capital market. So, on capital market competitiveness, Slovenia is also trailing in Europe with only marginal improvements since 2018. And I think we should therefore very much welcome the current efforts of the government in addressing capital market shallowness and hindrances in venture capital ecosystem with recently adopted and forthcoming strategies. So at the EIB Group, we are very eager to support Slovenia in this challenging environment. Over the last 5 years, the EIB Group has invested more than €1 billion in Slovenia, focusing on sustainable transport, energy infrastructure, and capital markets. And of course, this supported innovation and sustainable investments. In similar vein, the European Investment Fund invested over 200 million into venture capital, private capital funds. And again, we have a representative here in the panel today that is going to discuss this in greater detail. Also, the pipeline, both on advisory side and business side, is good. So we are very sure that we are going to support Slovenia on its path of innovation and sustainable development. Let me conclude. Europe's productivity growth lag, Slovenia's own challenges and barriers to investment are complex issues that require comprehensive and strategic transnational solutions. By implementing targeted policies and fostering intra-EU collaboration, Europe and Slovenia will navigate these challenges and build a more competitive, innovative and sustainable future. And of course, as the EIB Group, we are here to support these objectives. Thank you very much, and I'm wishing us all a great conference.
Thank you very much, and it's a real pleasure to be here again and have the opportunity of this discussion in such a challenging day, actually, of discussing economic issues and new trends around the world. So it's really a timely conference, as we discussed before. And it's a really uncertain time, and the U.S. Liberation Day, I think we all were yesterday evening looking at Trump announcements. This is changing substantially the geopolitical context and the way of that we know in terms of global trade and global patterns. Yes, it's true that U.S. import are 13% of global import, but this is a massive change that will require adjustment of global trading patterns around the world. At the same time, we have seen in the last period, we have been used, starting from the beginning of the year, the Munich Security Conference has put back on the European agenda quite strongly the need to look at defense and security. And I like to put the two concepts together. Security is part of the effort that we need to make at the European level. And what we see since then is an attempt of Europe to work together in this direction. And then we have seen in the last years, actually from the EIB, we have been talking since many years, but last year, again, it was with the Draghi-led report, the issue of competitiveness has been put on the top of a policy agenda at the member states and the European level, with a strong prioritization that is necessary if Europe wants to keep its rule at the global level. So we are in a very uncertain moment, but because we are so in an uncertain moment and because the challenges are so important, Europe really has to act together. And I think in the policy point of view, there is this focus on leveraging on what works, and what works is Europe working together, bringing a common solution, leveraging on the single market, and make it as efficient as possible. And only the common European response can help in this direction. I will go through a presentation that is the presentation of our annual report, also looking at some specific issues related to Slovenia. But I think the point to keep in mind is really this uncertain moment, extremely important challenge that Europe has to face: the globalization, the transformation of global patterns, defense and security, and competitiveness, and looking at what are the support factor, if you want, for Europe going forward. I skip just to mention here the security and defense and investment. Actually, investment is really coming as one of the important factors to support in all these areas that we have been looking as a key challenge. And if we look at the policy toolkit at the national European level, we make a strong case actually on 3 points. The fact that Europe needs to leverage on its assets, which are actually the integrated market, the integration, more integration, simplification, and innovation. Those are the 3 key words that we use at the moment. And we look at what Europe can leverage on. The EU Green leadership, I think, is something that brings support to Europe, and I will detail a little bit on that. The EU social investment model that is kind of an enabler, and the need to use policy intervention in a targeted and European way. So those are the elements that I will touch in my presentation. But let's start from the beginning. So we start from huge investment needs, and the huge investment needs that are coupled with a dynamic of investment overall in Europe that is actually showing 2 different aspects. On the one side, investment this time around, post-pandemic and post-energy crisis, has been still relatively good, supported by the public sector component, but lately investment has been starting to decline overall. The public sector component has been a driver of investment resilience, if you want, is the positive aspect. And if we look at the public investment side, what we see is public investment strong, but also the investment grants, so the public support to private investment that actually is peaking at the European level. So what we have is investment overall declining, mostly because of the private sector component, in a moment in which public investment is very strong, and the support to private investment is also very strong. So the question is how you keep accelerating investment when you are already using a lot of public policy ammunition for keeping investment going. And that's a key challenge for Europe. Slovenian side, we see a similar pattern, strong public investment support and investment overall at the end that is contracting. We have been looking at the history of investment in Europe and looking at when in history we had a period of sustained investment acceleration. And actually we find out that basically there are 4 periods. And the periods in which we had sustained acceleration were all periods in which there was a major structural transformation, and then this generated a business opportunity, and the private sector was investing, catching the business opportunity. So it's not only the public sector push, it's really the big structural transformation that generated the business opportunity. That happened at the moment of the creation of the European single market. There was also the Spain and Portugal access at that moment. It was a huge moment, a single market, a moment of huge opportunity, private sector invest, and substantial acceleration. There was the period of Euro adoption, Europe integration, if you want, the enlargement to the east, and lately there was a long period associated, is a bit more a mixed story, with the Recovery and Resilience Facility, but also with the Green Deal that creates a new market on the green technologies that also was pushing some investment transformation. So we have these periods that really tell us sustained period of investment acceleration, you need business opportunity. And that's why, and I think the next point. That's why in our analysis, but also the Commission is coming out with the same message, the accent is very much also on creating the business opportunity. And business opportunity means more European market integration and simplification. I think that's a way to read the whole policy response that is coming up. Why integration and simplification? I think this is even more important after yesterday. We need an integrated market. We need an integrated European market that give a base for resilience in Europe in the global context. And actually the integrated European market and an effective and efficient European market is one of the instruments that Europe has at the basis for its own resilience. And it's something quite important because it's something that is in the hands of Europeans to deal with it. Not easy, but in the hands of Europeans. We look in our report at a few things. On this side, you see something that we always look at. It's when we have this survey of 12,000 firms in Europe. Every year we ask what are the main barriers for firms' investment. And every year we have a very similar picture in the sense that skilled staff, uncertainty, energy cost are the three main barriers for firms' investment. You see the data for Slovenia. Very similar to the EU, in some area worse than the EU. I think the most important concern that is more of a concern, the highest concern and more of a concern than Europe is availability of skilled staff. That is something I think everybody can recognize with in the Slovenian market. There are some positive news if I compare Europe and US. Somehow business regulation seems to be slightly more positive. I think maybe Slovenian, that is something to look at. But we also were looking at two other things. So this is a barrier to firms. We also were estimating what we call the cost of bureaucracy. Cost of bureaucracy, we calculate it looking at the firms and asking how many people and staff do firms employ that are exclusively dedicated to deal with regulation. And then we look at the salary of these people. In fact, this is the estimated cost of bureaucracy is around 1.5–2% of total companies' turnover at the European and also at the Slovenian level. And it's not a low number if you think that the energy bill for companies is around 4%. So it's actually the energy bill you can relate more, you know what the energy crisis was, etc. The cost of bureaucracy is half of the energy bill cost. So it's not a low number, it's something that actually cost of bureaucracy is something Europe can deal with. And it's something that goes from the European level where measures are being implemented with the various omnibus regulations that are currently proposed, but it's something that trickles down at the national level with many measures that happens and sometimes overlap with the European one. But then there is the last point that is something that I really consider it a major opportunity for Europe, which is also a major, if you want, missed opportunity so far. We ask firms if when they export to another European market, they face barriers that are related to consumer protection standard, to VAT treatment, etc. In a fully functioning European single market, you should have a zero. That's a 60% in Europe, 85% in Slovenia. It means that goods or services cannot really trade freely within Europe. That means that we are complaining about what the US is doing to global trade, but we do it ourselves within the EU. So I think it's very important that Europe uses the opportunity of a stronger internal market to also react differently to the global context. The This is on simplification and integration. We also have, and I will have, I think, to speed up a little bit, we are reflecting on the capital market union or investment and saving union with two principles, with thinking at what really matters. And on the one side, we see that there is a loss opportunity on household saving point of view. Household savings in Europe are very much focused, and here you have Slovenia, but Europe is more or less the same, and you have the US. There is a very strong bias of household saving toward cash and deposits. That also means that the return of saving for household is very low. And that means that at a certain point in time, people will realize that they didn't accumulate enough for pension, and an aging population is not a good thing. And that's an issue in many countries in Europe. On the other side, we have institutions that could make the transition from savings into equity investment that are not really performing their role. Pension funds are relatively small, insurance corporates are slightly bigger in Europe. They invest a relatively little amount in equity already, but also when we invest it, there are two interesting things, and that's Europe overall. Pension funds, they mostly invest in equity in the rest of the world. That means that they don't find opportunity in the European market. Those are savings of European households directed to pensions, and they go in the international market. Insurance company, there is also something interesting. There is a very strong home bias. So it's not the European market being created. But then, and I go to the last point, and maybe I skip this, but it's a similar message. We end up on a lack of equity investment, and lack of equity investment, actually what does it mean? It means that innovative companies in Europe don't get enough financing. We monitor innovative companies in their life in Europe versus San Francisco. When they grow, they actually end up having 50% of the financing they will get in the US. And the innovative companies, particularly when they are growing, they really lack financing. So the investment and saving union is really a story of saving of people, moving toward more equity investment, having institutions like pension funds and insurance that really play the role of transformation on a European perspective, and having more opportunity for innovative companies for growth. And I think this is a top priority. I will quickly go through three additional elements. One is what Europe can leverage on. And I claim that the European green leadership is something Europe can really leverage on. Actually, there are a lot of things on, we have been too strict on reporting, etc. I'm not talking about that. I'm talking about being clear on the net zero transition path and on the need of decarbonizing our economy. And the effect that we see in Europe is important. In fact, in the innovation point of view on green tech, yes, China is good. Europe is also very good. And when we look at this is a collaboration pattern, so the network of collaboration pattern worldwide. And what you see is it's the only area of innovation in which this happens. Europe is at the center, so people want to collaborate with Europe. We have the knowledge and they want to collaborate with us. Yes, China is good, that's true, but we are more integrated. We are more of at the center of a collaboration network. We also have, and there is a mistake in the graph, I apologize, and it's a very important mistake. We have export, the green good export market grow. So the green goods grow. It's a very strong exporting market that is an expanding one. China is a leader, it's growing very fast. Europe is a leader, it's growing very fast. Slovenia, and that's a very important mistake, is not 22%, I think it's 65%. It's also gaining very fast. So, in fact, there are markets in which, through the net zero commitment, Europe made it in the innovation point of view and make it in the export market point of view. So the green economy is actually an economy that is growing and where Europe is playing its rules. I jump quickly. That's European and Slovenian firms in terms of their perception of opportunity and risk of the net zero transition. Interesting that the Slovenian firms don't seem to see that much the opportunity of the green economy. Actually, it's strange because they are actually profiting on the export side. So it's something to take more, and this 21% of seeing the opportunity is actually low, but it's something to take it more of a growing market where Europe has opportunity. On dealing with climate physical risk, Slovenian firms see the risk, actually they experience the risk, they are acting more or less like European firms. They seem to be more on having a strategy or buying insurance than doing something actively. So there is more of a thinking of doing something than actually doing it. So that's something important to look at. I just mention on this side, as we talk a lot about lack of skills, there is something that is interesting to look at. Actually, we were looking at the opportunity of bringing all EU countries to the best in class in terms of women in the workforce. So you kind of do a simulation and say all countries go to the best in class level of women in the workforce. And you see what's the effect on GDP in Europe, 4% increase. You do it in the other side. So it's an example of what social policies that allow more labor force participation of what they can do. And we think that social investment actually can have, if well done, economic return, and it's something important to look at. And Slovenia has good opportunities in that area as well as at the European level. I get to the final point, and actually I get to this slide that is the main part. There is a lot of talking about industrial policy at the European level, and it's an important moment to talk about this. What our analysis shows is actually that in the past, when policy support to firms was acted, it proved to be more efficient in two cases. When it's targeted to specific policy objective, actually, if you tell a firm, I give you money for doing energy efficiency investment, it's more likely that the firms invest in energy efficiency, but even just invest if you tell them on what they have to do and you check it. If you just give resources without a purpose, actually the effect is not so clear. And we think that being targeted is very important on the policy point of view, and it's also very important to do it European level. The reason is that whenever policy is enacted supporting firms, it can distort the market, and the distortion is bigger if it's acted at the national level rather than European level. And given the very strong importance of a strong European single market, I think the policy measure need to be more and more considered targeted and European. With that I close. I think the main message is we are in an uncertain time. It's really tough thinking how to adjust, but in all this environment, it's more important than ever that Europe acts together and look at its assets. And its assets are the integrated market, a competitive and integrated market. This means more market integration, simplification, focus on innovation finance, but also Europe can continue to leverage on its strengths, the green leadership, social investment also as a way for better human capital outcome. And then when policy intervention is addressed. I think targeted and European measures are the best. Thank you very much.
Welcome from my side as well. So I'll briefly present the findings on the survey of access to finance, the 2024 edition. Now, if maybe you're not all familiar with this survey, just a very quick few words about it. It's been conducted annually since 2011. Every year this is done in the last quarter of the year. So basically the findings that are presented here represent the sentiment of the responding companies towards the end of the year, around November. So bear in mind this. For Slovenian perspective, it's quite a large survey, so 3,000 companies, around 3,000 companies are selected to the sample. We have around 30% response rate, so each year we gather around 1,000 responses that are then further weighted in order to achieve representativeness of the sample. So the questionnaire broadly follows the ECB questionnaire on the access to finance. So first I will present this general part, then every year there is a special additional part regarding some pressing issues of the time. So obviously this in previous years there was the pandemic, then with the invasion of Russia there was the energy costs, then a very big issue in 2023 was the big floods in Slovenia. And well, this year we selected green transition as the special topic. So the last part of the presentation today will be dedicated to the responses of the transition. Now, maybe so most of the findings of the survey that will be presented will be quite in line with what you already heard from my predecessor, Debora. If you find some discrepancies, there might be some methodological issues. Some of the things that EIB was presenting actually relies on hard data, the actual numbers. This questionnaire mostly relies on binary questions. So the company is answering either yes, no, better, worse. So if there is a discrepancy in investments, so maybe still a lot of companies are investing, but they might be investing less. So in the hard numbers, you would see lowering investments, even though firms are still investing. Okay, now to the results themselves. So first, the business constraints. As you've seen already earlier, labor market continues to be the main business constraint. So costs of production of labor, as well as the availability of skills, is there at the forefront. Can't really see for that, but yeah. It's going down a little bit, so these constraints are a little bit lower than they were before, especially for the large companies, so the golden lines there. Same goes for inflation. This was included first in the 2022, and supply chains as well. We see a lowering, so since inflation is going down, also the constraints are going down as detected by the companies. The need for external financing, we saw a decline. There was a decline already in 2023. There was a further decline. Maybe what's interesting here is a little bit of a dichotomy between the large enterprises and the small and medium enterprises. The large enterprises saw an increase in the need for bank loans, whereas the smaller enterprises saw an increase in bank overdraft. Maybe another interesting point, and maybe something for discussion later on, there was an increase in the demand for equity. So firms do demand more equity. There was a big jump, especially among larger firms in 2023, a little bit of a decline in 2024, but still above the multi-annual average there. Financial gap is a detected difference between financial needs and availability of finance. We've seen an improvement in this gap. It remains positive, which means there is still more financial needs, that there is availability of finance. But there was quite a big improvement in 2024 compared to previous years. Now, the use of funds, mainly what companies are intending to do is they intend to use funds for investments and to finance current operations. Other uses are less pronounced here. There was an increase in the needs for investments, especially, again, amongst larger companies, but a stagnation or maybe slight increase among smaller companies financing the current operations. There was an increase for all sizes of companies. To complement a little bit on what was already said earlier, 54% of companies in our survey sought external financing. So there was 46% of companies that didn't even seek the external financing. Now, among those that were seeking external financing, these are the factors. Now, generally, a deterrent factor for external financing is mainly the worsening of the economic outlook. Even though at the end of 2024, this was a little less pronounced than it was in previous years. Now, on the other hand, what is triggering companies to seek external financing is mainly their operations, so their business. So if they are profitable, if they have a good credit history, and if they are strong on their own capital, they will also look for more external financing. Now, in terms of banking financing conditions, there's still a worsening across the board. Interest rates are still have quite an impact, even though the impact, of course, in 2024 saw a constant lowering of interest rates, so it became less of a constraint, even though companies still perceive interest rates at the end of 2024 as historically, at least in short-term history, quite high. Other costs also, even though we see both a decline in both of those factors. Now, 1/3 of the companies reported to have seek banking loans, so a loan from the bank, and the vast majority of the loans were actually even approved. Less than 10% of the loans were actually turned down by the banks. So the companies that do seek loans also get the loans. So it's not a major break there. Now a little bit about the expectations regarding availability of external financing. As was already pointed earlier, mostly companies expect to fund future investments with retained earnings or sale of assets, so with internal financing, less with external financing. There is an increase of expectations in taking banking loans, whereas the other sources of external financing remain pretty much stable. Now this is maybe where we can see a little bit of this discrepancy. So planned investments in the next 3 years, 90% of the companies actually report that they are going to invest, mainly in plant or equipment, but also other things like investments, business expansion, mergers, and so on. And sources, as already said, mainly internal funds. Now, the interesting part and the topic for today's conference, which is the green transition. companies reporting, so does green transition have or will have impact on your business? So in general, around half of the companies report that green transition is having or will have an impact on their transition. Now, among the large companies, this share is much, much higher. 80% of the large companies is doing so. What is maybe interesting is, so more than 3/4 or around 3/4 of manufacturing companies actually feel this, whereas on the other hand, almost half of the construction companies, they don't feel this. Then incentives for investments in green transition, they're mostly economic. Energy costs are the most pressing ones, and a lot of companies are doing actually investments in green finance in to lower the energy costs. Then on the second place, we have legislation and regulations, so they are doing it because they are pressed. Whereas you've seen this before, so direct threats, so the extreme weather impact is not such an important factor here. Now, obstacles, obviously high investment costs, so it costs money, so this is the most important obstacle. But I think what is really pressing, and maybe something for discussion later, changing of regulations and legislation. So unstable environment, and so the introduced insecurities because of it. It's a major deterrent factor, the second most important one that is being reported here. Now about planning. Mostly companies are thinking about it or doing something about it, but not really being there. At the forefront of actually the most active companies in terms of sectors are the services. Quite interesting and not so surprising. We've seen earlier construction companies don't think they will be affected, so they're also lagging behind in terms of planning about the green transition. Now, regarding investments, a lot of companies are actually reporting that they have investments underway. So, to some extent, they are investing something in the green transition. Not so many are completed. Really, the answer, investments being underway, is the most common one. Especially again, sectoral speaking, manufacturing is at the forefront here. And again, not surprisingly, construction is the one that is lagging. Now, investments are measured, implemented, mostly, again, economic reasons. So, increased recycling, increased waste reduction, energy efficiency measures. So mostly they are there, whereas the investment into stuff, into people, into knowledge about the green transition is quite lagging behind here. So mostly tangible investments, the one can be seen, not so much in the future. Now, we've seen a lot of people have, a lot of companies, they have investments on their way. So they are doing something about it, but the share of investments, so how much they are spending of the total investments in the green transition, is actually very low. So more than 3/4 of companies that report having invested or are doing investments at the time in green transition, they are reporting to be investing less than 10% into the green transition. The shares are low. So they are doing something, but it's not a major thing. So what are they spending? So how are they financing? Again, is same with the other investments, or even more so, internal resources. Especially if it's something that has to be done and doesn't have really a business plan, obviously you will need to rely on the internal sources. Also, you've seen that the share of this green transition investments is relatively low, so it's relatively easy for companies to actually invest the own funds rather than seek external funding for these investments. Now, factors. So, if they seek external financing, why would they do that? Because they get better interest rates, so there are special offers from banks. So that's reason number one. The other thing is, especially if you do some environmental resilience investments and so on, more favorable insurance. So the insurers are actually looking favorable on what you're doing. So these two reasons are at the forefront of doing the investments. So that's all from me. I bought some time, and I'm passing now the word to the panelists. Thank you.
Lepo pozdravljeni, še z moje strani, a warm welcome to all of you from my side. My name is Tina Žumer. I will be chairing this panel discussion today. As this is a jointly organized conference, we will discuss in English as we have many non-Slovene speaking guests with us. So I am really honored to have with us this distinguished panel that will bring together a really various perspective on how to revitalize investment, how to ensure the transition to new technologies, the green transition, and to deliver sustainable growth in these very, very uncertain times. So we have various perspectives from the government, from the business community, as well from the financial sector. So let me introduce the panelists. Starting from the left, we have Maja Bednaš, Acting Director of Institute of Macroeconomic Analysis and Development. Then we have with us Nina Dremel, President, Business Angels of Slovenia and Managing Partner at Vesna Deep Tech Fund. Welcome. Then we have with us Mateusz Frangaš, State Secretary, Ministry of Economy, Tourism and Sports. Welcome. Iztok Seljak, President, Managers Association of Slovenia and member of the Board of Directors of Hydria. And Mrs. Anita Stojčevska, Board Member of the OTP Bank in Slovenia. So we will have 2 rounds of questions for each participant, and then hopefully some time for the discussion at the end, so I will take questions from the audience. But before we start, let me just give you some facts to set the scene. A lot we've heard before, but just to recap a few figures for you. So since the early 2000s, the GDP per capita gap between the EU and the United States has doubled. So this is what the Draghi report finds. So I think this is a very good starting point to talk about the topic of our conference today. And one of the key factors behind this has been lagging productivity growth. While this was at par in Europe and the US, it stands only at 80% now. So the European worker produces 80% of what the US worker would produce. And where these differences come from is from innovation and capital-intensive sectors. So this is where the labor productivity in US doubled compared to Europe. And so if we want to close this productivity gap and deliver growth and a sustainable future for all of us, we need investment. So therefore the focus of today's conference is really investment. And to give you a number for Slovenia, where investment has been lagging behind even the EU, actually the investment share in the GDP has been since 2010 every year lower than in the EU by 2 percentage points, and it stands currently at 19% as a share of GDP, whereas in the EU as 21%. And our own estimates show that if we want to close or half close the gap in the productivity towards the euro area, we need to triple the investment rate in Slovenia over the next decade compared to what we saw over the last 10 years. So we see there are big challenges ahead of us, but also That means we have capacity. As we heard, we have a lot of opportunities. So with that, I would like to then now turn to the panel, and hopefully we'll have a lively discussion and address some of these questions and challenges. I will start with Mrs. Bednaš. Maja, could you please elaborate how you see the key structural weaknesses that may be hindering investment and growth in Slovenia and more generally the EU? Please.
Okay, thank you, Tina. Thank you, first of all, for invitation, for the opportunity to participate at this panel. I think I will echo of much of what has already been said in the first introductory presentations, as well as in your introductory remarks. Actually, if we are talking in Slovenia versus EU, it's the same story as EU versus US. So we are lagging behind the average because of the low productivity. We are, the data were published last week, and we are now at 85% of the EU average in terms of productivity. So the progress is very slow, and low investment, especially after financial crisis, 2008-2009, the investment declined in the beginning, but then if we look into the structure, now at the moment the government investment is already above the EU average, but business investment is below. And its growth was slow. Now we heard some reasons behind this slow growth of business investments. Availability of skilled labor force, uncertainty and energy costs, as also shown by EIB survey. But if we add risk aversion attitude of many Slovenian companies to this uncertainty, then this component is even more pronounced. So we are prudent, in one word. Now going more into some investments, business investments that are more innovation-led. They lead to more innovation, supported growth. We can see that Slovenia underinvests in mostly in intangible capital. So this innovation-led growth is supported by machinery and equipment, of course, by R&D, and some ICT investments like hardware, software, database. And this third component is the weakest. We perform very well in machinery and equipment, not so bad in R&D, but if we look into these intangibles, there is a significant lag. So this is one weakness. And also, European Innovation Index shows that we have some strengths also, not only weaknesses. So strengths are innovation activity, quality of human resources, also cooperation. This is interesting. But the weaknesses are mostly the digitization, so lack of professionals with very good digital skills. Some financial support, especially in form of venture capital, and also the business investment, especially in non-R&D part. So R&D is quite okay, but the non-R&D is weak. So these are some parts of investment that should be strengthened. And if I go just briefly to broader business environment, of course the predictability of business environment is very important. The reducing of red tape, of numerous regulations, so this is problem on EU level as well as in Slovenia. And we have one very good example which should be used in the broader terms. This is the case of Lake Sandoz, this major hub of biosimilar. pharmaceuticals. This is the major hub in Europe, and this is a very good case, good practice that should be broadened to innovation and to good transition green transition investments. So these are the areas. Maybe I should add also some subsidies should be more targeted to healthy core of economy and not to some companies that should actually go bust, because this leads to falling allocative efficiency. So there are a lot of areas that should be addressed, and I think that they're similar to what the Draghi report says about the EU level: more cooperation, more innovation, translating innovation into commercialization, decarbonization, and unfortunately security is now coming into the core, and we have to increase, not only in Slovenia but in the EU, expenditure for defense, which might lead to some extent also to reprioritization of some projects and also some crowding out, but this seems to be inevitable at the moment.
Thank you, Maja. You have pointed out many aspects, many areas that I think we will hear further on. Let me now move to the business sector perspective. I invite Mr. Seljak to give his view, please, on what do you think are the main obstacles for Slovenian companies for their competitiveness, and what is preventing them from investing, especially in high productivity enhancing technologies. Please.
I will try to be not too operational, because I think it's not a facelift that we need, it's a radical change that we should be after. Therefore, I would like to address the broader picture and come to your question through that. European Union was contributing in the middle of the 90s 35% of the global GDP. Today we are 30 years later on 15, and we are in the free fall, and we are losing competitiveness like crazy day by day. Australian study from 2 years ago, which is ancient old, in today's terms, is showing that in 43 industries of importance for the future, China is having a lead in 37 out of 43, a lead of 5 to 7 years. On the second place, there is US in all of those, and in all of those that China is not in the first, US is on the first, and Europe is in the comfort zone, sleeping, taking the last glimpse of the western sun on the beach, still taking the sun, looking from time to time to the east where the huge tsunami is coming, and hoping that next time when we look at the east it will not be there, it will be broader, nicer, etc., but it is all the time higher. And when it's going to hit our shores, and it's just coming like right now, it will wipe out everything up to 4,000 meters height. And we should better run the 27 all together as one in the proper direction and climb right now to be where we need to be. And we are not doing it at all. It should be we should be all over in crisis management. And this is a huge problem that we have, the total lack of the awareness of the burning platform that we find ourselves in, and the required radical changes. What we do instead, and we are looking at it each day, is a mixture from all over, Brussels, Paris, Berlin, Ljubljana, whatever, a mixture of vision without execution capabilities at all, which means daytime dreaming. And because we do not have that execution with vision, we have execution without vision, which is a nightmare. And in that execution without vision, we, the companies from Europe, maybe some industries, are playing against the colossus of this world, which are not just the companies, because they do have the government, the industry, the research institution, universities put in together in the whole thing, and are hammering us day by day. So we better go for destructive, creative destruction of the European Union's business model as we know it so far, because it is completely dysfunctional. It maybe was still working until the year 2000, not anymore in the global crisis 2008-9, obviously not. Because unless we will do it, the others will do it, but it will be much, much worse before it gets any better. It is not about the reconstruction, it is not about the facelift, it is about the fact that we have a dysfunctional European Union where the summary of the 27 states is less than the sum of each of them. And we are killing the value instead of creating the value. And we should figure out what is the right business model of the new age to confront the geostrategic issues as we need to. That will again result in some of the 27 more than the sum of each one. And I think, and Slovenia, I guess, should be the one to go with that to Brussels and to the European public, to say that we will need to decompose, go again to the basics, and put the whole thing together in a very different way. And moving from whatever European Union into the United States of Europe, by Slovenia being the first one to admitting that we will need to give up some of the decision rights in the very important elements, where if we will have the consensus of the 27 in everything, which we never do reach, where the only thing which can come out is a bad compromise, which never will be a breakthrough thing which we do need right now. And we will need to do that, and we better start talking about it, and we will need to change our democracy, the way we do the elections of the European president and the European government, which will be strong enough and capable enough to confront the US government, Chinese government, whoever, as one. Government, business, research institutions, finance, banks, everybody along the goal that we will stop falling from 35 to 15% of the global GDP, because we are on the free fall to 10% and in the way to oblivion, complete non-significance, that we will turn this around right now and back into the 20-25% range. And we better start now.
Thank you very much for this thought-provocative intervention, which I think leads us nicely to our next panelist, Mr. Franges, about the policy response. So we've heard before from the presentation from Debora that the targeted response is really what matters for investment. So could you share your perspective on the effectiveness of government policies in addressing this investment gap, in support investment, and which sectors in Slovenia do you see as a particular important in that respect? We will come to the forward-looking perspective of the policies in the second round. Yes, thank you.
Thank you for the question, but essentially you're asking me whether the industrial policy makes the magic happen or not. And yes, I think it does. It is proven. I'm a big fan of Mariano Mazzucato, so I'm a strong believer in the mission-oriented industrial policy. But let me go back on the points that Istok reflected. And I strongly agree with the core message he presented. Although I really believe that the European diagnosis on the why we came into this position is actually fundamentally wrong. Where is the core difference? Where does the core difference actually appear? And we can see that it appears on the peak of global financial crisis, where European and American and Chinese response is fundamentally different. When, and we were approximately the same to the US GDP at the time, what was European response? And it lasted up until COVID, austerity. Cut your public investment. Now we are facing the lack of skills. We haven't invested in skills, in our people, in competences, in innovation, in research and development for a decade. If you are looking for a reason why Europe is lagging behind, look at the wrong macroeconomic responses on the global financial crisis. First, US surpassed European Union, and by the end of the last decade, China did as well. And it also shows from the Draghi report, the innovation gap, the lack, the difference in the growth of the productivity in Europe and in US. What is Draghi's message? They invested into the new sectors with high risks. We were building on traditional industries. 80% of the global AI talent at this moment is employed by 4 American companies. And we are building and building dependencies on. So what is the role of the modern European state? Yes, of course, European and targeted. But it's also overcomplicated. I strongly believe not due to the high regulation. For example, I'll return to the skills that were reflected in the presentations. There are I believe two articles in the general block exemption regulation, so the EU state aid framework, that provides member state with the facility to support skills, investment in skills and competences of the companies. Although this is actually not a state aid, because when employer invests into the competences of its people, it actually invests in the general building of skills and competences of the public as a whole. And yes, we are low on this. However, there are also some good news, and let me reflect on them. First, I think that the major European change already happened, and that the revival of industrial policy that we see in, let's say, COVID and post-COVID times is already happening. Net Zero Industrial Act, now the Clean Industrial Deal, with a variety of pan-European measures that have to be put in forth. Second, Critical Raw Materials Act. We know that we have dependencies. And when we are talking about European dependencies, we usually talk about lithium, the photovoltaic capacities. No, the core European dependency, exporting European money from your pockets and the pockets of our citizens, is 96% of our dependency on import of fossil fuels. That's why we need a green transition. Not to make things a bit better, to fix the world and to fix our economy, and to lower the strategic dependencies we have on these sectors. And that's why innovation. And we have some new mechanisms. I'm a fan of Strategic Technologies for Europe platform. Slovenia would like to use it as much as possible. In beginning of May, we will do a public call for projects for development and production of strategic technologies. And what are strategic technologies? The clean tech, the biotech, the digital and deep tech. And you know, today the newspaper Delo published an article that Ministry of Economy is the ministry that reported the biggest amount of the lobbyist reports in last year. Actually, we are reporting all the connections with the private sector in a preventive way. But the biggest portion of those reports are actually presentations of new projects, new technologies that Slovenian industries, businesses, research institutes and startups are doing. And I would like to say that I'm feeling quite optimistic because I think that we already reached the wake-up call Istok is calling for. And then I see a lot of creativity, a lot of innovation among our entrepreneurs. We have to support them. We have to show that they have the competences to build the big, to win the big challenges we face as Europe and as a human race. You know, the optimism is very important drive. If we all fear of something, of war, that the Euro place in the world is you know, the best times are over. No, the best things are yet to come, because we have to encourage cooperation, we have to encourage innovation, we have to encourage investment. And with fear, with pessimism, you can have all the industrial policy in place by the book and you will not succeed. But if we empower ourselves with belief, with optimism, with hope, that yes, the better world is possible, and yes, we are yet to build better economy, then we can achieve everything. Sorry for being maybe too enthusiastic.
Thank you, thank you, thank you. I think it's very, very good to hear this enthusiastic and positive views. So we have projects to come. So let us turn now to the financial sector to see how those projects will be financed in the future. As we have seen, the reliance on external financing by companies generally, but in particularly in Slovenia, has been declining. So, Mrs. Stoichowska, what do you see, first of all, as the main factors why this is happening, and do you see opportunities from those projects that have been mentioned that will support the green transition, digital transition, and so on? Please.
Thank you also for inviting me and to be a part of this really, I think, inspiring on one side panel. Agreed that the reliance on external financing decreased in Slovenia. There are many factors. We can go a little bit back to the history. We know that in 2009 we had quite a huge financial crisis in Slovenia, where the banks, especially domestic one and state-owned, they need to tighten the, let's say, lending conditions in order that we also stabilize the banking sector. On the other hand, the companies, as they were too much relied on banking sector, they start to also, let's say, build their own funds to, let's say, to invest in their capacities. So how this was done? So in the many years, they increased their profitability. So we see that, for example, in the last 4 years, the net profit of the companies increased from 4.6 billion to 6.7 billion. Even if we, let's say, take into account the inflation, you know, it's still a real growth behind. With that, with the, let's say, retained profits, they were able to accumulate some their own equity, which they then were able also to finance. Currently, what we see from the balance sheet of 2023, because the 2024 are still not available, we see that the debt to EBITDA ratio, it's really low. It's 1.7, which means that companies are able to repay all these financial liabilities less than 2 years. You know, so this is good. And this shows that we have companies which are credit-worthy and they have high, let's say, ratings. On the other side, it could be that these companies do not invest enough. We saw also from the, let's say, the survey which was done by EIB, that currently our companies are mainly investing in the, let's say, renewal of the existing, let's say, equipment, and not so much in the expansion, to the extension of their capabilities, not so much in the new technologies. This is what was already mentioned. Let's say the companies, nevertheless, they still rely majority on banking funds, but here, as it was seen, now from banks are not the obstacle, I would say. Of course, we could have better interest rates and so on, but banks has an ability to finance, let's say, the growth of the companies, their digital transformation and also green transformation, but we need to have projects. But here, it's also important that we say that in the banking sector, in order that we would support these companies to go in that direction, we'd also need to have higher expertise, that we will be able to, let's say, assess all these projects, because all these projects, which could be, and they will be more, let's say, related to the sustainability, we need to understand them, because they are not anymore plain vanilla, I would say, or standard one, but they will be, let's say, tailored. And for that, we also need to have tailored financial solutions. What we also see on the field when we are visiting the companies, let's say the large companies, they're aware of all this, let's say, need for the sustainability, digitalization, and so on, because they are also part of the, let's say, supply chain, where their buyers or their partners are also requiring from them to report about the measures which they took to be more sustainable. On the other hand, we see on SMEs that they are aware that there could be some opportunities related to the sustainability, but they go a little bit slower because the risks and also investment needed to go in that direction are higher. What is also important to say, and I think that Istok and also Mr. Frangesh mentioned, is for the larger project in Slovenia, so strategic one. Here, the partnership needs to be much broader. It's not enough only the banking sector, we need state, we need other financial institutions, we need also local communities. We know that currently in Slovenia, in order that we place some bigger strategic, let's say, investment infrastructure projects, it takes too long time that we persuade a lot of different communities that we put this project, that we start to work on this project. So here, let's say, I think that one of the important factor would be also that how we will place this project in the landscape, and also that the state has an ability that they use the right of the public interest when we are discussing about really big projects. I think this is very important, and this can, of course, through public investments, can bring additional, let's say, turnover and also business for our private sector.
Thank you very much for this intervention. What I found interesting was, again, you mentioned capacity building knowledge. Even in the banks, you need to know the knowledge to understand. So it's a word that is coming up front in many presentations as well before. So we need to invest in that. And now to turn to the other financing sector, let's say, to less developed now in Slovenia or generally in Europe, but rising. Mrs. Dremer, the area of venture capital and so what do you think, maybe as a starting point, could you explain us what are the differences between financing, venture capital financing versus traditional financing for a company, and what do they mean for growth and innovation? And as we've seen before, we are very low in Slovenia in terms of venture capital. What are the reasons for that?
Okay, thank you for the invitation. So, let me tell you the story. Okay, if I would now explain venture capital from the point of view of a startup, the story would go like this. So none of those people here exists for me because they don't see me. That's the main point. So what the startup is? Startup is not a young company. It's not company with young people. It's not company just with the idea. Startup is usually, and in vast of the cases, group of people who has the most promising knowledge on certain point, either some technology, some business model, whatever you want, who have a brilliant idea, who check the market and there's a huge need on it to actually solve this problem that they are planning to solve, who have boldness that none of those people is looking for, because this doesn't bring money on the table yet, who has the idea and who knows the market. And startup is actually the company that has to prove their business model. Once they prove the business model, they become company. And here we go when the venture comes into the game. Venture capital is quite broader world. We have business angels, we have venture capital funds, we have dedicated venture capital funds, we have private equity, we have secondaries, and thousands of different financing instruments in between to support those players. Business angels are entrepreneurs, successful one. Maybe they've done the exit from their own companies, maybe they're still active. But what they have is an extra mile of boldness that understands, those people understand, and we have roughly around 100 business angels only in Slovenia, which is huge success. We are growing every year by year, but it's still not easy work to do it. Why? Because those people have eagerness, they understand that the business itself cannot become successful if there's nobody to support it. So startups are super fast. You have to understand the startup usually is sold, let's say for Slovenian circumstances, between 8 to 10 years after they are established. It's a speed drive. It's not like classical way, doing it slowly with everything predicted with strategies. Everything exists in a startup, but they have to be super fast. Why? Because they are disruptive. Usually they have to teach market, hey, we are existing, we have some novelty, you have to accept it, and market should respond to that. Or they are super disruptive within some technology, and industry have to adapt it, or regulators, or the markets in general. And there comes the point where the business angels enter to the game. They are the one who supports with early stage steps startups with small money that comes from their own business. So they are actually people with a mission to give back to the community, to give back to the most promising startup entrepreneurs, not just to help them financially, but also with mentoring, with channels, whatever is needed. And those people deserve a reward, especially in Slovenia, because they are unicorn. On the other side, Slovene startups are amazing. They are well known in the world in general. Why? Usually best technologies are arriving from here. Great engineers, so the talent is existing, but nobody is supporting it, except us. And they are actually super successful when they enter any of the markets that are outside of EU. Venture capital is a bit different. Usually business angels are becoming also investors in venture capital funds. Why? Because venture capital funds have only one mission. This is support early stage, the most risky phases of the startup development to provide the growth, speed growth. So it's a kind of hockey stick. Maybe some of you saw it. So there on the bottom of hockey stick is a debt valley. So we are there. We are supporting this debt valley not to happen, not to startup not to die. And venture capital is a bit different because angels are investing their own money by their own preferences into the startups they want. VC has GPs, so-called general partners, who invest their own money into the fund, and they usually collect different investors, either from industry, either from European Investment Fund, either from pension funds, banks, insurance companies, and private investors. So the natural path goes from business angel to investor in the fund. What happens in VC? VC is managing other people's money plus their own. And they have strategy, they have policy, and they have dedicated sizes of the tickets, how much they can invest and where. And they are market-focused, industry-focused, depends. And the beauty lies there that the VC funds, they actually get married with prenuptial agreement. They have to go out. And that means in less than 10 years, they will be out of the company. If we compare this to traditional, there's a time for development. There are banks who are supporting them. Startup is not even on the map of the banks. They never can even enter into KYC, not even doing it, because they have nothing to give them to do KYC. Traditional investing is through the loans, through the bigger mezzanine funds, etc. So they have time, startup doesn't have time. Startups are disruptive. So this is actually something that is an answer to the innovation and the position of Europe. Europe should act like or behave as a startup company. We should be fast. That's the only reason why we are not there as we should be.
Thank you for this very, I would say, novel perspective to many of us in the audience, I would say, especially also here at the central bank. So, but it's very important we bring together all these views. Let me now turn to the second round of questions, in which we will be more forward-looking. We will also try to address or identify policies and interplay between various actors that would solve some of the issues that we have identified and boost productivity. Again, I will start, Maja, with you. So we hear a lot about the need for policies, industrial policies, policy support, and so on. So in your view, which areas have the greatest potential to policy areas to enhance innovation and drive productivity growth in Slovenia, but perhaps also more widely in the EU, as we know that we are part of the EU?
Okay, thank you. I will share actually some findings of our report that is coming in May. This is development report which combines our previous development and productivity reports. So I will share some of our recommendations. We will also present it to the government. Of course, the report is much broader, but when we focus on productivity and investment issues, of course, digitalization, innovation are the key words. Also, strategic approach to human resource management, because we heard that the availability of skilled workers is a serious problem. So we see this as a demographic issue, so we have to put some effort into longer working life, into attracting skilled labor, foreign labor force, to adjust also working place or the so-called age management in a workplace. Then education is very important. The education system should be more responsive to the changing needs of economy. So all these aspects are broad issues, but if I go more into specifics, and we heard something about death valleys, this is very important part. So our R&D investments are at the moment more focused on basic science, so the beginning of development phase, and then the close to the market phase. But in between there is a death valley, which is high risk R&D investment, and this needs complementary corporate and state funding, some business angels, and this would then entice companies, enterprises to go from these more incremental innovations to more disruptive innovations that would bring some breakthrough also in development. Of course, the integration of advanced technologies is still an issue. This is in line with principles of Industry 4.0, and this goes especially for small and medium companies. Large companies perform quite okay, but in small and medium-sized companies, this is still a big challenge, and I'm not even talking about the Industry 5.0. Then, of course, tackling the red tape, all regulations, all permits. This is a big issue, not just building permits, but all kind of permits that have to be obtained for companies to start to operate. And, of course, predictability of business environment is always important. In tax front, as I mentioned, red tape. And to conclude, I will say that cooperation and integration in not only on national level but on EU level, as also mentioned in the presentation of EIB, is at the core. We have to act more coordinated. I mean, in Slovenia, we are talking about the cooperation of production and services of large and small medium-sized companies, then cooperation with knowledge institutions or academia and enterprises. This could bring synergies, or on the other hand, without cooperation, we can have even bigger problems now, especially from yesterday on. I think that the cooperation and coordinated response at the EU level is at the core, but also reducing all bureaucratic barriers is very important. I believe that challenges are very similar for Slovenia as the EU, and actions, there are already some action plans adopted at the EU level, and Slovenia can always benefit from this. And we, at the national level, we have to take the similar steps, but I think that State Secretary will have something to add to that.
Thank you, Maja. Indeed, I would like to ask you, Mr. Frangish, to comment on what we have heard. Can you share with us any insights what the government is really thinking of, any incentives or projects, policies that would help incentivize investment also in Slovenia, but also in the EU-wide context?
Well, I fully agree with the need for agility. Maybe being agile is what Dr. Seljak called for before. We have built great ecosystems so far. GREMO initiative, Green Mobility, is an example of such ecosystem, but it's not the only one. We have several strategic research innovation partnerships in the core strategic sectors in Slovenia, complemented with, let's say, self-driven sectors. For example, the newly established Slovenia Biotech Hills initiative that presents an ecosystem, space. Everything Slovenia did in space was done in the last 10 to 15 years. And it also presents a small sector of 50 companies, research institutes, 3 Slovenian universities that already gain European traction, is involved in European space programs, and in some cases achieve very, very high growth. So strengthening the ecosystemic approach is one thing. This is also a regular recommendation of UMAR report on productivity. Second, a lot of things were mentioned. what Mariana Mazzucato says, industrial policy is not only about de-risking, it's about sharing risks. And I totally agree that the biggest possible boost in our productivity lays in the sectors where there are huge risks. And we cannot expect from the private sector to cover all the risks by themselves. So and here we see a huge need of a public-private cooperation in order to bridge the risks such projects face. The infrastructure. Slovenia is very well connected. Of course, we have a huge gap in air connectivity, but we are getting better and better, both in highways as well as on trains. But Mrs. Stochevska mentioned the lack of proper area to invest in new projects. We are very active in attracting new strategic projects. Lake Sandoz investment was mentioned. Revolt's investment in Novo Mesto. A lot of other investments from both European as well as other investors in, for example, biopharmaceutical field, which already presents the biggest export sector in Slovenia. The government, and I hope that this plan will be presented in several weeks, would like to focus on some national logistics and business centers with a national centralized approach to, in spatial planning as well as the area development. The developer function in Slovenia is underdeveloped. It's also capital intensive, but it also provides great returns. And here the financial sector should also step in because these are safe investments, but they need great support from the financial sector. In order to build several national business and logistic zones, complemented with the 12 regional zones, in order to have available land to host investment. And yes, we are seeing a lot of nearshoring, a lot of Europe-focused interest, but of course also here the price of land, the timelines to host such an investment, and of course also the state support in order to support such investment is crucial. Let me quote the vice president of the Renault Group that covers their industrial sites from South Korea to Turkey, European sites in France, Spain and Latin America. And he said on the dinner with Minister Hahn last year, an evening before we signed the memorandum with Renault, he said that the approach of Slovenia was unique, that something, the engagement, the support, something they didn't see anywhere, from Korea to Latin America. So I think we are good in building relations. Why automotive industry is so strongly engaged in German industrial chains? Because they are precise, they're reliable, and they build relations. And they bring an innovative element on the table. And I think it also describes Slovenia as a nation. You know, I believe we are a great combination. German influence, precision, good engineering, reliability. Some Mediterranean influence, you know, La Vita Bella, we don't live to work, but we work to live. And of course, a very important small ingredient, the Balkan influence. We are people with a sense of humor, which is a great combination. And I truly believe that in this combination, in the forthcoming years, we have to just work efficiently, and yes, state has several issues regarding that. We are slow, we are overcomplicated, and when thinking about the common and targeted European response, let's have in mind small economies, and that the rules shouldn't be as complicated as they are, because it's often we find in a circle without the option to exit action. We are the 7th most robotized economy in the world, 11th most complex economy in the world, that proved its ability to deliver high technology products. However, we have a low investment in new sectors like data collection, data usage, a variety of digital tools specifically in the SME sector. So these are the gaps that needs to be filled, and government has instruments in order to boost the investment and engagement of these in these sectors in the forthcoming years. Thank you.
Thank you very much. Mr. Seljak, to complement, so while the government is primarily responsible to design the measures and incentives to create a stimulative business environment and to support innovation and investment, the feedback from the business sector is very important on that. So what do you see from that perspective would be the most efficient policy measures that Slovenian companies would want to see that would be stimulative to innovation and investment?
I guess you might see that with the Mateusz government and myself, private sector, there's a genuine, very positive and constructive cooperation. We work a lot together. I think we should even more. Which is weird, by the way, for my other colleagues, presidents of other economic associations. You know, I'm working together with the government, because in Slovenia it's normal that we are working against each other, not with each other. Just to say that we have a lot to do in terms of adopting our mentality, also from the business side, not just only from the politics side, right? So we are working a lot together, and you can see, you know, we have aligned already on a lot of things, right? I'm looking now, you know, just the color of the shirt and the shoes exactly missing. Yeah, or the opposite. We'll figure it out, right? Talking about the optimism or pessimism, you know, many times I'm taken when I'm doing what I'm doing here today, the wake-up call, as a pessimist, which is obviously, at least from my perspective, completely wrong, because by doing this, and I'm consistently doing this for years, I'm provoking the reactions, hopefully in everybody, of a wake-up call to understand that we need to run, and people do start to run, which gives me the ground for being the biggest optimist in the European Union overall for years, because of this wake-up call. And you know, sorry, the negative feelings are much stronger than the positive feelings. And when in Hydria, in 2005, when we were extrapolating mega trends for the future in our industry's mobility, and we figured out that by 2015, all will be stop-start, 2020 hybrids, 2030, 25, all electric, and we were 100% dependent on internal combustion engine and fossil fuels. You know, I didn't go after them. We have a challenge, you know, but we're going to make it nice. Let's go slowly as we did so far. No, it was about we are in front of extinguishing non-existence anymore because our business is disappearing. And you know, Churchill, whatever, blood, sweat, and tears. We are at the seaside, 4,000, war terminology. This is what it was. And we are today, you know, from 200 million to 500 million. And the leading European company in solutions for electrical vehicles with a lot of optimism all of the time. As far as Slovenia is concerned, just to touch upon also this part, and again, right, the wake-up call. 30 years ago, talking before about the European Union, 30 years ago, I guess Slovenia was below the average GDP in Europe. And here we are, 30 years later, 1.5 generation, 24/7 a day, us, me including, we are below the average of the GDP of the European Union, which sank in between, as we have clearly explained. So what did it do really? We should ask ourselves some fundamental questions, I think, about finally moving from, being occupied with, is it the left, is it the right, is it red or white or black, into maybe green in a completely different sense, and thinking about, going not left, right, but forward and upstairs and upwards, and together, not one against each other, but together as one. It is about time also here. And yes, we are creating the examples, right? Primož has been mentioned, and I fully agree, we are very likely too small to be global leader in everything, which China is afterwards. But imagine, as I'm spending almost half of my time in the Middle East now and with Saudi Arabia, the nation of 38 million, yes, in a completely different background, is after the globally leading position in almost everything. We cannot. And we should focus, and we should talk openly about that we need to focus on, yes, pharmaceuticals, biotech, IT, artificial intelligence, excellent ground. Let's integrate it with the automotive to be globally leading in this field. Space technologies, whatever is there, right? Let's bring it together properly. But then again, in a partnership, state, government, research institutions, put all together to have the vision and its execution capabilities. And Gremo is such a case, which was there in 2020 already. And we successfully did breakthrough projects so far. And as Mateusz knows, unfortunately, but now for 2 years already we are stalling with the next step, and with the next 30 million to be with a grounded optimism to support the innovative breakthrough on this part. Because in the last 2 years, as we are sleeping, China went into the stratosphere literally with the photovoltaic plants in the sky high and artificial intelligence, no people asphalting the roads are out, etc., etc. And we are thinking about whatever we are thinking about and losing time. So, we are right now going in the wrong direction overall. Slowly, thanks God, at least we are slow. We are already having the signs of the capabilities of going into the right direction, but we need to speed everything up because the time is scarce. We do not have it. But again, just the color of the shirt and the shoes, we are in the proper direction. So,
thank you. Good to hear that the direction is right, so we just need a bit more speed. And you also mentioned the partnership, so with that I would turn to Mrs. Stoichkova on the financial products going ahead. So to support this investment, innovation, so do you have any particular financial products in mind that could be in support? A lot has been, we talked 2 years ago at this conference about the blended finance, so the cooperation between private, public funding, so maybe a few words on that.
Yeah, in this, let's say, environment, surely the standardized products will not play anymore, they will not be enough. Simply, maybe it will be enough for retail part, but not for corporate part, So as I said already at the beginning, for the, let's say, ideas for innovations and all that, we would need tailored financial solutions, So what means that? That we will need in the banking sector surely to understand all the business models and what the new things are bringing for the company and what value added will bring, and then to structure the deal in a sense that it will be viable, that it will be at the end also profitable, and of course that we will at the end get the loan back. Support also the economy to do this, or the company to produce what they would like to achieve, but of course at the end the loan needs to be repaid. So here the upskilling and reskilling of banking employees is of course the essence. So all these new technologies and all what we need to step in because surely the companies will invest more and more in digitalization, and we will need to understand what this is bringing more, will require new experts, which they will understand the business of specific companies. This is on one side, so tailored financial solution. Another side, which was already mentioned, is this, let's say, cohesion, or let's say blended financing, where we have on one side banking funds and on other side, let's say, public funds to support some of the projects which are maybe of the high risk. Because at the end, in the bank, we need to assess all the risks. This is our, let's say, primary role. A part of that we need to, let's say, transform our deposits to the loans. But at the end, we need to also to bring back to our clients. So here we have some good practices. You know, we have, for example, in Slovenia, Slovene Enterprise Fund, where we do in this, let's say, blended financing, where Slovene Development Fund is supporting some SMEs or even startups with either guarantees, subsidized interest rates, or even the, let's say, the knowledge. Also on the level of European Union and also EIB and ECB, we have a lot of funds which are available. But first we need to have the investment, and we need to have, let's say, the motivation, you know, that we encourage, I would say, that we step into the different shoes. Because not only the economy has to change, but also, of course, the banking sector too. What I would like here to say, I think that Slovene economy showed in the last 5 years, at least 5 years, quite huge resilience. And there is a lot of, it's a good base. It's a good base. We need just to have a little bit of more impulse, you know, a little bit more of courage, you know, that we can do more. And I'm sure that in Slovenia we have a lot of people who did already some things which are worldwide known, and we need just to build on that. What we need is, of course, at the end, less disruptive environment, you know, less bureaucracy, which was already mentioned, you know, and much more cooperation.
Thank you. So this brings us to the last question. We've heard the resilience of the Slovenian economy. So which sectors, Mrs. Remer, do you recognize in Slovenia as have the greatest potential to benefit from venture capital and business angel development?
So they are not the same. So business angels are not so strong to support certain sectors, whereas on the other side, venture capital can do it. But I would say from a current market landscape, the biggest opportunities are lying within the deep tech. It's a quite broader sector, but within this deep tech, in Slovenia, biotech, medtech, food, so advanced food technologies, and advanced materials. Why? Because the majority of basic research is done and supported in these sectors. Also great companies were established also in the past out of those sectors that are currently the most prominent. But nevertheless, for angels and for the, let's say, classical venture capital funds, still B2B software companies are one of the most promising. Maybe you heard that the last news that just popped out recently is that Slovenian/Swiss connection of two entrepreneurs gained 70 million of funding unfortunately not from Slovenia, but for the disruptive deep tech solution in AI. Numbers are telling by themselves. So we have, for instance, it was already mentioned in the morning, 5% PhD per capita, whereas worldwide average is 1%. That's a huge difference. On the other side, out of those 5% PhDs, only 0.03% of this knowledge is commercialized. So I think that the biggest value lies, not just for Slovenia, but also for Europe, within the commercialization of IP that Europe has. I could claim, from my perspective, the strongest one, because we are the land of engineers. We have really good development skills. We are strategists, so we can do it. But it needs to have this shift out of just research into the commercialization. And the second point is, what is also the promising is that with all these new initiatives, also our fund, Vesna Deep Tech Fund, and among Pan Adria, which is for the growth, and the other two succession funds that are coming, is the initiative from Seed Banka, so-called CEGIP, really, really important. Why? Because finally we have bigger funds with support of EIF that are now present in Slovenia for Slovenian companies. And the main, let's say, the main value of those funds, nevertheless, this is not the best option for VC managers, is that we are actually investing in Slovenian companies. So the companies have to literally be here. And numbers are again speaking for themselves. In 2023, because these are the last data from Dilum, this is the international platform for the startups, in Slovenia we had 600 new startups in 2023. 81 million was invested as a venture. I can easily say that maybe 10 of those millions were invested by Slovenians. The rest came from outside, which is not okay. But in 2023, we didn't have these newly established funds. So I'm hoping that out of this, we will have better results. But not just that, every million that is invested in Slovenian startups is generating 50 new employments. And our mission is actually to hold these companies here because we would love to have the full investment life cycle. Meaning also that hopefully Europe will become in next 5 years so strong that we will be able to do exits on a home playground, not in USA, China, and the rest of the world. So this is actually the landscape that I envisage, not just me, but also my colleagues from this world. Nevertheless, we have to diversify from market, from industries. We do have potential here, but that means that this is the collective power to do it and collective support that needs to arrive from not just government, not just banks, not just venture capitals, but from the people, so that instead of 41 euros invested per capita into startup in Slovenia, we would be reaching out to Estonian standard, which is almost 2,000 euros per capita. And that should be the goal.
Thank you very much. So we reached our time, but as we started late and we have this distinguished panel, I would really want to stay 5 more minutes if you have time, and open the floor for 1 or 2 questions, quick questions, please. If somebody has here first.
Thank you very much. Thank you very much. Just have a follow-up question maybe to representative of the auto industry and the Ministry of Economy. And the question is very simple and very obvious. How do you assess last night, of course, World Economic Conference, and whether the analysis in this foreign trade barrier, which is very interesting to read, reading how America sees us, how would you respond? What is next in line? I mean, okay, one cannot say that they did really came with a reciprocal tariffs which are much stronger than actually what we are doing there. Would EU, sort of a council competition, which Ministry of Economy would go this way, or would we find another way? And for economy, for the business, what's the plan?
Thank you. It's a very complex question, requires for a lot of time, but maybe just a very quick response here. If it's possible to have a quick response.
Dr. Seljak suggested that I start. Well, I wouldn't rush on a joint road to madness. So let's be very cautious. Let's do our signals. Of course, that we are considering the reciprocity in effects. But I would, for now, wait, because it seems very clearly that the madness on the other side of the Atlantic already creates economic disturbance. We saw what happened to the stock exchange markets. We are seeing a rise of inflation and also possible step into the recession. And I would say that these clear economic indicators will help prevent stepping the world into the wrong way. I have to say that I always believe that if one nation really benefited from the open trade and multilateral trade agreements, these were the US. So I don't really understand where we were, in which actions EU acted as nasty or unfair. I'm using quotes. However, for the case of Slovenia, it is very clear that we could be affected on several cases. In direct exchange, you know that our numbers are quite low. However, for example, automotive industry could be affected indirectly due to the change of German performance on the US market. But also we are importing several important ingredients in, for example, chemical industry, the pharmaceutical industry, and this could be, of course, affected. But as I said, let's keep our heads on our necks, use our brains, and step into the talks very cautiously. That would be the suggestion, and that is also the policy.
Okay. Mr. Seljak.
The easier parts are some thoughts in terms of potentially being a politician, which I'm not, and the more tougher is, of course, what I am. That is the professional industry, right? Some thoughts on that. As far as from a political point of view, I'd still try to understand the facts that US have, for whatever reason, huge deficit in their foreign trade, huge. Consequently, maybe not just because of that, but they have a huge budget deficit and it's non-sustainable. They need to do something, whether this is the right direction or not. They need to do something. Now, in terms of response, I would see a very optimistic element in the whole thing, which you mentioned, Mateusz, as a reciprocity, which is something which also we will very likely need to understand and then deep dive a little bit more. And at the end of the day, if we have the reciprocity now for the start of 25% in both directions, whatever, maybe it's a good start to start negotiating that 0 in both directions is better than 25 in both directions, etc. So I would see some, elements of potential positive developments for here. From the industry side, I would say that while we need to follow it, while we are the victims of all that, we need to understand it. I think the industry needs to, Europe, ourselves in Slovenia, needs to start occupying ourselves much, much less with the others and starting to occupy ourselves with ourselves in terms of Things didn't really change in the last 200 years or more in the human history. If we will want to be successful, we still need to have designed and innovated the best product possible of this or the next generation. And we need to have the capability to innovate the processes and technologies that we will make it by the lower cost than anybody else. And we will be more competitive than anyone else around the globe. And this is what we need to do in this case as well.
Okay. Thank you very much. Since we are now really out of time, I would stop our discussion here and ask you to join me for a big applause for these great panelists today. So I hope we can finish with some optimism, with some positive tone. I think we have heard a lot of this as well. So I invite you to take this home from this conference, and hopefully we see each other again on a similar event next year. Thank you very much.